Welcome to Market Blaster, where we blow apart the stock market and put it back together so that it makes sense for you. I'm Forbes Markets Editor John Dobis. Get your rally caps on, kind of like the 86 New York Mets are in this photograph right here. The stock market is rallying, up better than 10% for the S&P 500 index since June 1st. Here's the SPY that tracks it. You can see that we're on the verge of taking out the highs from April of this year in the S&P. We're now up 10% from June 1st, as I say. Nice little move there. Why are we up? Well, it was really anticipation for what the central bankers could do in terms of easing monetary policy. Mario Draghi on the left-hand side here at the ECB said that he would do whatever it takes to make sure that the problems in Spain and Italy and Greece don't go any further. That would include buying the bonds of those countries and maybe, if they ask for it, direct bailouts. Of course, he needs help from the rest of Europe and especially Germany, which he doesn't quite have yet, but apparently Mario's on his way to achieving such consensus in Europe. Our man over here, the central banker in charge at the Fed, Ben Bernanke, he had promised to do what it takes to get the economy moving again. Of course, we had 3 horrible months from April, May, and June for the unemployment report, and we had about 80,000 or so new jobs created those 3 months, and the first 3 months of the year, over 200,000 new jobs. July's report, though, was a little bit better than that. We had more than 100,000 jobs created, more than expected. Will it make Bernanke not launch another round of quantitative easing? That's not really sure yet. The markets rallied a lot in anticipation that the Fed would come to the aid of the economy and the market. Now maybe it may not need the Fed. Of course, we had the fiscal cliff. You've heard of the fiscal cliff. Those are the $1 trillion in spending cuts over 10 years that will happen effective January 2013, and a whole host of tax increases. Higher taxes on dividends, higher taxes on capital gains, and higher marginal income tax rates. But both these guys are working very hard for election. Of course, Mitt Romney's running mate, Paul Ryan, is an active member. He's in the House Budget Committee, for gosh sake. So these guys have a vested interest that we don't swan dive off the fiscal cliff. So maybe there'll be some kind of an action achieved there to avoid that. Coming up in 2 weeks, Ben Bernanke is going out to Wyoming, not for fly fishing, but instead to bait the world on the possibility of his third round of quantitative easing or some other kind of extraordinary monetary operation, if you will. Ben's going out there not too far from Devil's Tower, having a close encounter out there with the world's central bankers and intelligentsia. Crude oil. Crude oil is sniffed what the central banks are cooking and the economy overall. Crude's rallied nicely, bubbling higher from about $78 per barrel to $93 for West Texas Intermediate crude, 1 barrel thereof. Of course, oil is still down substantially from its $110 peak earlier this year, but as hopes for the economy to be reinvigorated, or at least more inflationary forces out there have taken hold, oil has come back strongly. Pain at the pump is also coming back. Gas prices are up about 8% in the past 2 weeks, now nearly $3.69 per gallon. What that means is the refiners now have gasoline that costs more, that they can sell for more, and they were buying cheap oil. And that's the crack spread, folks. High crack spread equals fat times for the refiners. Valero up from about $20 on June 1st to $28, more than a 40% gain in shares of Valero. Tesoro Petroleum, TSO, that's gone from 22 to 38 on fire. And of course, Holly Frontier, HFC, hasn't really got the same kinds of gains, $28 to almost $40. Decent little move right there in the refiners. Gold, a commodity that responds well to inflationary forces, or at least the threat thereof, hasn't really been moving so much. Gold, since it peaked at $19.20 per ounce last August in the depths of the monetary and the fiscal crisis over in Europe, it's back down now to around $1,600 per ounce. But if that round of quantitative easing comes, or if negative real interest rates persist, that is, the nominal rate minus the rate of inflation is negative, gold will do well. And some people like to point to this pennant that's forming right here, a flag pattern, if you will. You can see it's going down, big bounces, smaller bounces, kind of like a ball. And when the ball stops bouncing, the bet is that the trend, at least this is what market technicians say, the trend that existed prior to the flag pattern will reassert itself. That would take us above the old highs, of course, at 1920. Gold could be looking at 2,000 some per ounce at some point later this year or next. Gold miners, the guys who get it out of the ground, they've been doing pretty well lately. The GDX is the ETF that holds a bunch of them, and it's moved from $41 to $44, actually about 45. It's down a little bit right now. But a 10% move there in the gold miners. Companies like Gold Corp, it had been to around $38, got knocked down to 32, and what do you know? It's back up to around $37 per share for Gold Corp. You've got Gold Fields, a South African producer. It's up nicely as well. Technology, Apple. Apple's been busting higher. Lots of talk about the Apple iPhone 5, a possible mini iPad. Unconfirmed, but a lot of talk that it's coming. That's really boosted the entire tech sector. Here's the QQQ. This is the PowerShares QQQ that own things like Intel, all the big non-financial companies in the NASDAQ composite. Intel, Oracle, Cisco, Apple. Apple shares right here, forming a nice little cup with handle. You see the old-fashioned coffee cup? This pattern right here is called the cup. We're waiting on a handle to form, but you can see the general outline of an old-school coffee cup right there. You can expect from the 630 per share, maybe a little bit of a back off right here before we go after the old high at 644. On the nose, by the way, from where Apple was just in April before it came down. Apple's still looking very strong. Google may have lost probably the cutest executive in all of the tech world, and she looks a lot like Reese Witherspoon. Marissa Mayer, of course, she went to go head up Yahoo from her post at Google. But the stock, since Miss Mayer left, probably no cause and effect relationship, has absolutely torn it up. About $560 per share late July, $667, up about $100 or more there for shares of Google. Google doing very well. They have the most popular operating system for mobile phones, Android, and their search is still par excellence, dans le web. Facebook, the picture just kind of gets uglier right there. It's looking frightful. The stock came out, of course, at $38 per share and now is plumbing new lows near $21 per share. More reports coming out all the time about all the people on the inside who sold as much as they could before the stock, as the stock came public. Groupon, another epic fail right here. There's some doubts about the market value of the company, what it's actually worth long term, because people who use these coupons probably don't go back to the merchants for full price stuff, and that's the only reason that merchants would actually get into this business. Anyway, Groupon, as you see, after earnings this week, found new lows, $5.35 per share. Stock was above 12 about 3 months ago. Now for some, not dead cat, but we'll call them live cats, because these are live cats, and it's not nice to talk about dead cats, but let's talk about some cats on the bounce right here. Green Mountain Coffee. By the way, Green Mountain, RIM, and Netflix are all stocks that are down 75 to 80% in the past year. Big time losers. But look at these bounces just in the month of August. You've got Green Mountain up 28%. From its very low lows, obviously. RIM managing a 6.2% gain for the month of August. And Netflix up better than 13% in the month of August. So you can still win with the market's losers if you buy them at the right time. We're also doing well in the model portfolio for a new newsletter that we launched here at Forbes, and I'm the editor of Forbes Dividend Stock Daily. We got into companies like Cablevision. Cablevision is up 20% for us. Our yield to cost is about 3.7%, and as I say, a 20% gain there. Nucor up about 10%. We got about a 3.7% yield to cost there. Steelcase, Staples, France Telecom, all doing quite well. Don't miss any more. Go to ForbesNewsletters.com. That's ForbesNewsletters.com. Check out Forbes Dividend Stock Daily in the upper left-hand corner. Don't miss out on any more picks there. You can make some money.